I don't think global markets are fully priced in a longer war between the US and Iran. All the research that I read says, oh, it's going to be a week. Trump has a plan. He's not telling us what the plan is, and he's going to achieve it in a week, and they'll have a deal because it benefits both sides, and then we'll go back to where we were a week and a half ago, which is everything's fine. I mean, I think that Bitcoin will be much higher by the end of the year than it is right now. Does that mean I would buy Bitcoin right now? I wouldn't buy anything right now. I think that right now is the time to hopefully you have some spare capital. The time is now to do nothing. There's nothing to do. There's only to wait for them to print the money. It's futile to try to say, oh, I read some analysts about the war and they think it's going to be 5 days versus 6 days. So I'm going to go and buy whatever you're going to buy, right? You don't know. Everything you read is propaganda. You have no idea what is actually happening. Bitcoin, I think, will respond positively to more money printed from central banks to assuage the effects of this AI the knowledge worker destruction, but you have to have the crisis first. So we have to go down to go up.
Bitcoin has been bleeding for 6 months straight, down about 50% from its all-time high while gold rises and stocks hold. Yet crypto, the supposed future of money, has been hammered. Most people are blaming the macro, the war, the uncertainty, the rate environment. Meanwhile, Arthur Hayes sees a deeper issue the market hasn't priced in, explaining Bitcoin's behavior and why that dynamic could eventually reverse. According to Hayes, Bitcoin isn't broken. Rather, it's behaving exactly as intended, like a smoke alarm signaling a coming fire. So in this video, we're breaking down his full thesis, why he's not buying right now, what signal he's waiting for, and why he believes Bitcoin will end 2026 significantly higher than where it sits today.
All these commodities, if this war continues on in the future, I don't know how long it's going to last for, but the longer it lasts, the more disruption. And these systems are nonlinear. When you shut something off, it's not like, okay, Iran and the US declared peace, therefore oil production goes right back up. No, if you destroyed all this infrastructure, you've got to rebuild it. It takes time. And then you have to have confidence from business leaders to come in and reinvest in this region. Do you have confidence to go rebuild your refinery or to send ships through this thing just because, Trump and whoever the leader of Iran has agreed for now for a ceasefire? They had a ceasefire in June of last year. Less than 12 months later, they're at it again. So what's to say that in the next few days, if there's some sort of truce or deal, that in another 12 months, Trump doesn't bomb them again? We don't know, right? And so this is the uncertainty that's going to play on folks reinvesting in the region. And so I think the longer this goes on, the harder it is to rebuild that confidence and that trust, and the more we're going to have disruption to these critical trade flows and energy supplies. And over time, I think that means that central banks will print money to sort of like wash away the effects of this, which is why I think in the medium term, Bitcoin could benefit the longer that the war goes on. But at the right now, I say this is a no trade zone. You've got the position you have. Don't alter it. Don't increase risk. You should only be reducing risk. And so right now, what are we doing? We're sitting on our hands and just watching the charts. We're not doing anything.
Arthur Hayes delivered a very direct message. Right now, this is a no-trade zone. His point is simple. Markets are pricing this war with Iran as lasting a week. Analysts are calling it a short, calculated operation. Investors are treating it like a minor bump. But Hayes doesn't buy that. He argues these systems are non-linear. When energy infrastructure is destroyed, it can't just be switched back on after a ceasefire. It must be rebuilt, and investor confidence must return. And given that the US and Iran had a ceasefire less than 12 months ago, and here they are again, why would anyone rush to rebuild trust this time? The longer this drags on, the more disruption it causes to global trade and energy supply. And Hayes says, over time, that forces central banks into one inevitable response: print money to wash away the effects.
Bitcoin is down 50% in the last 6 months, so I'd say a minor bounce off of the low doesn't really prove anything. And also, I don't think global markets are fully priced in a longer war between the US and Iran. All the research that I read says, oh, it's going to be a week. Trump has a plan. He's not telling us what the plan is, and he's going to achieve it in a week, and they'll have a deal because it benefits both sides, and then we'll go back to where we were a week and a half ago, which is everything's fine. Consensus, and we can see that in the markets. S&P and NASDAQ aren't really down that much given the enormity of what could transpire in this region. Yeah, oil's at like $80 or $75 to $80. Nothing crazy in terms of a spike in oil prices. So I don't think people don't believe this war is going to last very long. Whether or not that's the case, we're going to find out. One example that I'll cite in my favor is the Gulf War between the U.S. and Iraq in 1990. U.S. chose to invade Iraq. Oil prices spiked. The Fed continued to cut rates in the face of spiking oil because they wanted to support the American war machine. Now, they didn't say it like that. They had a very euphemistic term for the Middle East disruption or, some term like that. But at the end of the day, oil rose. Fed was cutting rates in the early 90s in the face of inflation. And ultimately, that's why H.W. Bush lost the election in 1992 to Clinton, was inflation. So I think that if it's a choice between supporting the American war machine or trying to engineer recession so that people use less oil, the Fed is going to support the war machine. Just today, Trump announced that he has guaranteed shipping through the strait. He said, we're going to have American ships escorting vessels through the strait, and we're going to help provide insurance to maritime insurance where the private market refuses to. So how is he going to pay for that? He's going to have to print money. Let's assume that, there's now the USA Strait of Hormuz insurance, and your ship unfortunately gets bombed by an Iranian or Houthi drone, and now you're out hundreds of millions of dollars. Well, okay, the U.S. government's going to write you a check. Where's that money going to come from? They're going to have to print the money. They're going to have Scott Bessent's going to issue bonds. Someone's going to have to buy those bonds. If someone's not buying the bonds, then the Fed's going to have to monetize the debt.
With this context, his core thesis becomes even more interesting. Most analysts argue that a war-driven oil spike will lead to higher inflation, and that higher inflation will prompt central banks to tighten. No rate cuts, no liquidity, bad for Bitcoin. Hayes pushes back hard on this. He points to the Gulf War in 1990. Oil prices spiked, inflation rose. And what did the Fed do? They kept cutting rates because their priority wasn't controlling inflation. It was financing the war machine. George Bush lost the 1992 election partly because of that inflation, but the Fed still supported the war. Hayes says the same logic applies. The Fed will prioritize military needs over prices by printing money and issuing bonds. If bonds go unsold, the Fed steps in.
I think that Bitcoin will be much higher by the end of the year than it is right now. Does that mean I would buy Bitcoin right now? I wouldn't buy anything right now. I think that right now is the time to hopefully you have some spare capital. The time is now to do nothing. There's nothing to do. There's only to wait for them to print the money. It's futile to try to say, oh, I read some analysts about the war and they think it's going to be 5 days versus 6 days. So I'm going to go and buy whatever you're going to buy, right? You don't know. Everything you read is propaganda. You have no idea what is actually happening, whether, Iranian, Israeli, United States, Western Europe, you have no idea what is actually happening. We see the videos that, people are posting about things, but like what's in the minds of these leaders, what their actual goals are, we have no idea. All we see is the propaganda. So just wait. If the war lasts long enough where central banks are printing money, then they print the money and then you buy it. If they do nothing, you do nothing. And so I think it's foolish to say, oh, I have to start buying now because in 6 months' time, Bitcoin is going to be, up or down, whatever percentage. And then you put on a trade and, who knows how the war is going to end. And all of a sudden you start losing money and then you exit the trade and you've just lost a little bit of your capital because you had no conviction and you have no idea what is actually happening. So yeah, if you had to pin me to a number, I have no fucking idea. I think the Bitcoin will be higher by the end of the year. I think a lot of these things will play out by then. Would I put fresh positions on right now, given the state of information that I have? No. Right now I am doing nothing. I'm just watching.
Before getting into his recommendations, Hayes draws a crucial distinction. He's not saying go buy Bitcoin today. He's saying wait. His exact view is that Bitcoin will be higher by the end of the year, but I would not put myself in a fresh position right now. Not with this level of uncertainty. Not when you genuinely have no idea how long this war lasts or what happens next. Everything you're reading is propaganda. No one outside the actual decision rooms knows what these leaders are planning. And trying to trade based on that noise is how you bleed capital on a position you have zero conviction in. His advice is blunt. If you already have your position, sit on it. Don't increase risk. Don't do anything, just watch.
So I wrote an essay a few weeks ago called "This is Fine" about my theory that Bitcoin is acting as an early warning indicator that there's a massive credit destruction event brewing, especially in Western financial markets, which I believe Bitcoin follows more in terms of the amount of fiat liquidity printed, especially from the United States and the US dollar. And that basically comes from looking at how does Bitcoin perform versus the NASDAQ, which in recent history has been pretty correlated. And what we've seen over the last sort of 6 months is the NASDAQ's been flat to minor down, while Bitcoin's dumped what, like 50% from the all-time high. Why is that? I think that Bitcoin is forecasting that there's going to be a massive credit negative event due to AI disruption. And we've seen the start of that with the crash of these SaaS companies, these software companies out of the US, who now have competition from firms like Anthropic, where a agent can do the job of somebody with a very expensive SaaS subscription for $10 a month. And so these stocks have gotten hammered. The people who extended credit to these companies have gotten hammered. And now we're starting to see the beginnings of firms like Block. Dorsey last week announced that he was cutting 40% of his workforce because of efficiencies gained by using AI productivity tools. So if we expand that out into a larger framework, I think that Bitcoin is telling us there are going to be a lot of formerly high-paid workers, especially in the United States, who consumed a lot of things, who had a lot of debt, and if 10 to 20% of those folks are eradicated due to AI efficiencies at a lot of large corporations, even small startups, then how is that debt going to be serviced? And if the banks that lent all this money to these people can no longer get monthly payments, then the solvency of these banks comes into question as well. And this is what I believe Bitcoin is telling us, because it's moving in lockstep with ETFs like the IGV, which tracks US SaaS companies. And we're seeing, NASDAQ treading water, because obviously NVIDIA and some of the other companies are, doing quite well selling the hardware of this CapEx build out. So that's kind of where I've landed on why Bitcoin has dumped 50%, where the broader, international and US equity markets have pretty much held flat or increased over the same time frame. If you take a look at what Bitcoin responds the most to, it's fiat liquidity. And so if we're saying that we're going to destroy a bunch of credit in the banking system, and as of right now, most central banks, especially the Federal Reserve in the US, believe that AI is going to be positive for the economy. Productivity is going to increase. No one's going to lose their jobs. The GDP is going to increase. Taxes are going to go up. They think that AI is the best thing that's ever happened to the economy. It's going to allow every economy to outgrow all this debt that they've issued over the last few decades. And so if the central bank believes that AI is a benign, if not positive force for the economy, why would they cut rates preemptively or increase liquidity to the banking system? Until there's an actual crisis, until there's banks actually failing, until the depositors are fleeing the small banks for the big banks, that's when the Fed acts. Bitcoin says, okay, well, if they're not going to provide the credit and this destruction event's going to happen, then I'm selling off. And that's what I think the market is telling us. So yes, Bitcoin, I think, will respond positively to more money printing from central banks to assuage the effects of this AI knowledge worker destruction, but you have to have the crisis first. So we have to go down to go up.
Building on this, here's what adds another layer to Hayes' views on Bitcoin. Even before this war, he had a theory for why Bitcoin dropped roughly 50% in 6 months, while the NASDAQ was flat. He calls Bitcoin a liquidity smoke alarm. Here's the logic. AI is beginning to eliminate high-paying knowledge worker jobs at a pace most people aren't ready for. Not 100% of jobs, but 10 to 20% of the people who had mortgages, car loans, credit card debt, and student debt, all financed by those salaries. Bitcoin, in his view, was already sniffing out a massive credit destruction event, driven not by war, but by AI. When those incomes disappear, those debts can't be serviced. When debts can't be serviced, the banks holding those loans are in trouble. Specifically, the smaller regional banks are without government guarantees. And the Fed, right now, still believes AI is good for the economy. Productivity up, GDP up. No reason to print yet, so Bitcoin is saying the crisis is coming, but the Fed hasn't acted yet, and until they act, Bitcoin keeps selling off. Hayes' bottom line: you need the crisis first. You have to go down before you go up.
And obviously, crypto goes through cycles just like everything else. I was wrong about Bitcoin not crashing in the 4-year cycle. We'll see if it recovers this year or it doesn't. But I still believe that at the end of the day, what we know is true, unless told otherwise. Politicians are going to print money. And so Bitcoin and crypto are the most responsive to all this fiat that will be created, that is and will be created in the future. And therefore, we have a structural path to number go up for things. So it doesn't mean number go up for everything. Obviously, most of the things that are in this industry are complete dog shit and are worth zero. But again, that's just any new technology field. And I like it. I've been doing this for over a decade. It's what I understand. And so, yeah, I'll deal with the bear market, and it's a great time to invest in quality founders and projects. And that's what we do at Maelstrom. So even though the prices might be down right now, I love this. This is how you get the next 100x trade for the next 2-year cycle or whatever. So yes, could we have this era of AI abundance where labor is worth zero and intelligence is free and we get to, just gallivant around the world and play tennis all day? Sure, we can get there. But before we get there, everyone who had a job building stuff, taking care of kids, doing knowledge work, lawyers, accountants, bankers, they all get fired, right? They all have debt. That debt is now worth, the asset that debt represents in a banking system's balance sheet is now worth zero because those cannot service the debts. And all the profits flow to the few companies that make money in AI. And so before we have a general conversation socially about how do you share this productivity, it's going to accrete to very few individuals. So the mass of people will be broke and bankrupt. The banking system that houses all their debt as assets can no longer service that debt. And those with all the money say that they deserve to keep it all because they were smarter than everyone else and they invested their capital wisely, right? So before we get to the utopia, we have the depression where we as a global society have to determine how do we share this abundance that AI could create. And if we can't learn how to share, we'll probably blow ourselves up. If we can, then we can move to the next stage and have, a utopia or whatever. The banks are bailed out by governments, just like they always have been. So the central bank has a choice. Do I allow this credit destruction to happen and the free market to operate and, bad credits to be worth zero and clear? Or do I do like I've done every single other crisis, say, oh, the banking system's in trouble. There's all this debt that's worth zero. To keep the system going, I will underwrite it by printing the money to cover the losses. And that's how crypto goes up markedly, because all that liquidity flows to the scarce assets.
So, where does all of this leave Bitcoin in 2026? Hayes doesn't give a price target, but his framework is clear. When the credit destruction hits, whether it's AI-driven job losses, war-driven inflation, or both, central banks will respond the same way they always have. They will print, they will bail out banks, they will underwrite the losses, and that liquidity flows directly into scarce assets, including Bitcoin. That's the trade. Not today, not this week. But when the money starts moving, Bitcoin is positioned to respond faster and harder than almost anything else. The people who will win in the next cycle are the ones who didn't panic out at the bottom and didn't chase the noise in the middle. Right now, Hayes is just watching, waiting for the printer to turn on. When it does, he says, the move in Bitcoin will be hard to miss. Thanks for watching. Don't forget to like and subscribe. See you in the next video.